Good morning, everybody. Welcome to today's 1Mby1M Strategy Roundtable for Entrepreneurs. 1M1M, as you know, is the first global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we do these roundtables week after week after week. It's been going on since the 2008 fall, when we started experimenting and tinkering with this format of online mentoring. And this is the 384th session, so we're coming up to a milestone of 400 sessions later this summer. And we've had over 60,000 people participate in this program, in the free roundtables. And today we touch a community of over 500,000 people around the world. And it literally is around the world. You could meet, in one of these sessions, you could meet people from Ghana or, all kinds of places that we never even, make any proactive efforts to reach out to. So it has been a real privilege and a fascinating experience learning about what people are doing around the world. This event is being recorded. You will have the recording available on our YouTube channel, 1M1M Roundtables. All prior recordings are available there, so it's a great learning material. If you just want to, if you have like commute time or just time to, spend on learning, these are all free. You can listen to, a few sessions and you will learn a lot, I can guarantee you. If you are following us on Twitter, our handles are at 1M1M or at Stromana, or if you're not, please follow them. We do publish a lot of interesting content through those channels. And our hashtag is 1M1M for today's live tweeting, if you're interested in doing that. This is a roundtable, so we want you to participate as actively as possible. And you have two ways of doing that. Either you can call in. These are the call-in numbers. I'll put this slide up a little bit later when we're ready for you to call in. And you can also participate in public chat. So make sure you set your chat to send to all participants, not to me, not to the host, not to Maureen, but to all participants so that you can interact with the peer group. Introduce yourselves, tell us where you're joining from, what you're working on, what you are facing roadblocks on, so that we can strategize and work on your situations. This is a working session. We're going to start today's session with Gaurav Jain, Managing Partner of Afore Capital. Gaurav, welcome. It's great to have you here.
Thank you. It's a pleasure to be here. And I was just listening to your opening, opening sort of description of what you're doing. It's incredible, right? Because with the internet these days, there's entrepreneurs like all over the world, right? And at some level, it's unfortunate that we can't be involved in companies everywhere. We tend to have a lot more portfolio companies in the Bay Area or in the U.S. generally. We have a few outside, but it's great to see what you're doing, because I think there's entrepreneurship talent everywhere, and there's great companies that are going to be built everywhere in the world. So it's actually, I didn't know a whole lot about your mission, but that makes a lot of sense.
Well, and as you heard me say, 1Mby1M is 1 million entrepreneurs times 1 million in revenue. I did not say we are trying to fund 1 million companies, which I don't think is viable, actually. So, however, of course, we have also a large community of entrepreneurs who are in the venture path. So that's why we want to talk to people like yourself. And in particular, with your specific focus, which is pre-seed investments, we are very, very interested in hearing your perspective, because as you know, that part of the ecosystem is very underserved. People want validated businesses, people want, seed, post-seed, and now the pre-seed is where the tricky part of the equation is. So tell us about Afore Capital. What are you trying to do? How are you positioning yourselves? And let's get you introduced to our audience.
Awesome. Thank you. So Afore Capital is a $47 million vehicle exclusively focused on investing in pre-seed companies. And that makes us the largest fund that's focused on pre-seed. And my partner and I, we started this fund in 2016. Both of us had been in venture for a few years. So my personal background real quick, software engineer by training, and then I moved into product. I was one of the first product managers for Android. Did that for a few years, saw the platform go from, less than 1 million total users to about 1 million new installations a day, and of course, 2 billion people use it today. Then I switched gears into venture. I was at a fund called Founder Collective, doing seed investments. But what I noticed, within for 4.5 years, is that a seed round went from what was around $1 million to $2 million round when I joined Founder Collective in 2012 to a $3 to $5 million round. In a lot of cases, I think in 2016 there was like 98 seed rounds that were over $5 million in size. And for most of these companies, seed round was not their first round, right? They had to raise some money before there. Because, as you mentioned, the investors are looking for scale or looking for some level of traction, product market fit before they're ready to invest. So these founders struggled to raise that round before the seed round because there just weren't that many institutional investors willing to invest. My partner's background is similar, software engineer. He was the first product manager at Twitter, one of the first employees, and then he was an investor in a Series A and B fund called Foundation Capital. And both of us noticed something similar, as I alluded to, that there was this gap, right, for founders to be able to raise that sort of first round of funding before there's traction, before there's product market fit, before it's clear whether it's going to work or not. And we saw that gap. I saw that as an opportunity, left our respective funds where we had a great path, but felt that we really had a passion for investing early and felt we could create value. So we left, raised some money primarily from institutional investors, so pension trusts, sovereign wealth funds, so on and so forth, who also saw an opportunity to fill this gap and have outsized returns, right? Because the competition is less in this space, you can get a pretty good valuation for these companies, and then for the ones that work, you get outsized returns. So we raised this vehicle. We've invested about 20 companies so far. Our typical check size is somewhere between kind of $250K to $600K or so. The rounds are, the smallest one we've probably done is like a $330,000 round. On the larger end, they tend to be around $1 million, $1.5 million. But in all of these cases, first round of funding, these companies were not ready to kind of scale, sales and user acquisition. They really had to focus on product. And given my partner and I, my background in being product managers, having been there early at the ground floor, we could really be helpful, right? First of all, we can identify really strong product talent, which is what we look for above all else, is do you have an ability to build a product that customers will love, right? A product that's 10x better than what's already out there. Because there's no traction yet, we need to get some level of confidence that when you do launch this product that it's going to take off, right? And I think the way we do that is start to understand, how good the product DNA is on the team, what non-obvious insights that the team has around building this product. And if we get excited, we make an investment and get very actively involved with these companies between the pre-seed and sort of the seed round, or in some cases, we've seen companies go straight from pre-seed to Series A, right? It really depends on what you can accomplish in sort of that 12 months post our investment. And what sectors, obviously, Series investors are actively investing in, so on and so forth. So we've done about 20 investments. Across the board, some are, B2B, building SaaS enterprise software, B2C, e-commerce. So we're less kind of caught up on the exact sector that you're building a company in. We're more interested in sort of the application and the use case, right? We believe that the founders know exactly where the opportunity is. They can point us to where the world is going. And in fact, they're the ones that are going to build that vision of the world anyway. So we don't get too caught up in sort of predicting where the world's going to go. Instead, we spend our time looking for the best founders that are early where we can be helpful.
When you say early and pre-seed, can you put a bit more color around that? Are you willing to make concept financing? Like if somebody just presents the concept and doesn't have an MVP or a product, are you willing to put that $250,000, $300K in?
The short answer is yes. The long answer, though, is these days it's gotten so cheap to build an MVP, especially if you're building a software product, which is where 80–90% of our investments are going to be, is a software-heavy business. Or even if it's a services, business like a, Uber, for example, like a transportation business where you're moving stuff, it's software enabled, right? So to get something out there to show some interest from customers, you don't need a whole lot of money, right? Between Amazon Web Services, which is pay-as-you-go, between all the open source software, which is free, I mean, these days to build a prototype, literally all you need is a laptop and access to the internet, right? For which you don't necessarily need capital and a few months of human labor. I think human labor is really where the bottleneck is, and that's what we look for, are founders that are able to build a product themselves, right? Or at least one of the founders is technical. I think the challenge becomes when both founders are non-technical and they need to go hire engineers before they can write a single line of code. Those ones are a little bit harder for us for a lot of reasons we can dig into if you'd like. So in most cases, the founders have been able to get something out there without needing any capital. So a typical trajectory would be, you're working at a tech company. It's a couple of founders. They have this idea that they've been toying with for a few months. Maybe they've been hacking on the evenings and weekends, and they get really excited. They leave the job, right? And that's when we get to know them, right? It's typically around the time when they're leaving, quitting their job and moving on. But then we stay in touch with them and help them for a few months as they are kind of hacking on product, hacking on the exact direction. And then when they're ready to, and part of the reason we don't invest at sort of that concept stage is because a lot of times that concept changes, right? Very quickly within the first few months as the engineers start to iterate. So you don't want to raise money too early from a founder's perspective either, because if you raise money getting investors excited about this direction, but you realize that's actually not the direction you're excited about for a whole host of reasons, you want to go in this direction, that becomes a little bit tense, right? Because now you have to convince the investors that is the new direction, is the right direction to go in. So because the cycle times are so short in the first few months and so much is going to change, we encourage founders to kind of wait, for 3 to 4 months until they have some semblance of kind of the direction they want to run it, at least for the next 6 to 12 months, right? There's still going to be a lot of iteration. There's still going to be a lot of sort of micro pivots in the first 12 months. And something looks like in 5 years is going to be very different, and that's okay. But we need some level of clarity for the next 12 months, and hence we rarely invest at sort of the, hey, I just came up with this idea this morning, or 2 weeks ago I've been thinking a lot about it and I'm looking for some money. We tend to wait for a little bit. The cases where we have invested is founders we've known for a while. They have launched products before. They have launched, maybe they built a couple companies before, and we just want to be, in partnership with this founder. But I'd say 90% of the companies, if not more, they have some prototype, something that we can get our hands around.
I got it. So you're basically, your sweet spot is technical founders who have tinkered for a few months and built something and has an idea of where they want to position that product, and then you take it from there. You're okay with the micro pivots, but you have some directional movement already in swing, basically.
Yeah, but one thing I want to clarify is we're very comfortable taking on traction risk, right? We're very comfortable when you build the prototype, it doesn't have a lot of traction yet, right? It doesn't make any money yet. And it's not clear if, maybe 100 customers love it. Does that mean 1 million are going to like it? We don't know, right? That is something we're comfortable with. So we don't need to wait for, your business and humming and hawing before we invest. But that sort of initial work, we like to see that.
But, for a B2B business, 100 customers, getting to 100 customers is not an easy thing to do right away.
Sure. And for B2B, it depends on obviously the size of your customer, right? If they're paying you $10 a month, getting 1,500 customers is not hard. If they're paying you $10,000 a month, then maybe 1 or 2 is great. So, of course, it depends on
it depends on the size. Got it.
Exactly. And if it's a consumer company, you want to see even more than 100.
More than that, yeah. So, quickly, what about geography? Are you local focused or U.S. focused, global focused? What's the comfort zone?
Yeah, both of us are based in San Francisco, but our mandate doesn't prevent us from investing anywhere, in the world.
Okay.
I'd say our strong bias is towards U.S.-based companies, or U.S. and Canada. I would say I grew up in Canada, so definitely the soft spot there. I've made a few investments in Canada. But I'd say we have a bias towards that just because, we have a network there, we can be helpful, for recruiting, for follow-on investments, for business development, a whole host of reasons that, just we can do a much better job for you in North America. But we have made investments outside. There's a company that's based in India that we're investors in out of Afore. So we're totally open to non-American investments as well, but, the bar is just going to be higher. I think what we would want to see are really mature founders that need sort of less of our help and are able to, tap into the local network and perhaps even raise money from Silicon Valley follow-on investors, even though they're sitting, somewhere else.
Well, the issue that you bring up India, the issue that we see in India is that if you're doing, let's say B2B SaaS out of India, which is a very popular category in the Indian investment pool, you kind of very soon realize that you're going to need to build it as a global business, and you're better off being based in the U.S. because for a lot of reasons, the access to capital in India is okay right now, especially in the early stages. There is capital, but exits are few and far between. So it's from the point of view of exits, people are realizing that they're better off being a U.S. company with an Indian subsidiary as opposed to the other way around. So two questions. First and foremost, we'd like to learn a bit more about the highlights of your portfolio and give us some of your thought process on how you decided on these particular companies. What was it about those companies that really struck you and attracted you and convinced you that there is something interesting and important in there?
Yeah. So what we look for, as we were talking earlier, are the founders and their sort of product DNA and ability to build a game-changing product above all else, right? Because at the stage we invest, there's not much traction. It's not even clear what market you're going after. I know a lot of investors will tell you, go after a big market because, you're going to get a small percentage of that, and that's sort of the most important thing. For better or for worse, that's not sort of how we think, just because our best companies tend to be in markets that it wasn't very clear when they got started at the stage we invested in. So I'll share a few portfolio companies, both from my old fund, Founder Collective, where I was for many years, and then Afore. Out of Founder Collective, some of the notable ones are did the seed in a company called Cruise Automation that was building driverless cars. That was eventually acquired by General Motors, and Kyle, who's the founder CEO, now runs autonomous division for GM. And it was a great exit for all the investors, because we invested in the seed and it was acquired for close to $1 billion. The reason I got excited about Cruise Automation is I remember Kyle drove me down the 101 here in San Francisco when he was giving me a demo of what he had built, and it was a pretty primitive product, right? All it did was keep the car in between the two lanes in a highway, right? Barely, by the way, because it started raining that day and the autonomous controls went off. But it was very rudimentary product. But there was like 2 people on the team at that time. And I said, Kyle, look, I've worked for Google before. I know Google's been investing in driverless cars for a long time. They're far along. Tesla's thinking about it, so on and so forth. This is 2014 or so. Maybe 2013. I said, help me understand why is the startup going to thrive and win and outcompete, Google and Tesla and everybody else. He said, look, I understand it's really hard to build a very R&D heavy company as a startup, as a venture-backed startup, but all of those folks are working on the product in the lab, right? They're trying to, get a perfect product out there, and then they're going to scale. As a startup, and especially as a startup entrepreneur who thinks like a consumer product manager, I'm going to get a very small fraction of the final product out there in the market in the hands of the customer. And I'm going to gather a lot of data, and I'm going to learn a lot, because when it comes to driverless cars, data is really where, you win or lose. The more data you can gather, the better your models are. He said, I'm going to gather a lot of data, so all I'm going to launch by the end of the year is an ability to keep your lane, keep your car in between the two lanes and change lanes on a highway. Something very simple, which a lot of cars already have, but, I'm going to get some early adopters to try the product with the vision that I can build driverless cars down the road. And I'm gonna put a big hard drive in the trunk, and I'm gonna give you free car washes. And then when every week you come in for a free car wash, I'm gonna download all that data. Anyway, he had all these insights that were non-obvious, that made a lot of sense. There was a very lofty vision, but I got that feeling that, well, there's a lot of risk, and it could totally go to zero. But if he's right, if some of these things work out, this could be really massive, right? And that's what we look for in the companies is, we don't make a list of what can go wrong, because that list, unfortunately, is just too long and too real. Instead, we look for what can go right? If the founder is able to accomplish these sort of counterintuitive things, could this be a massive business? Could this be a massive opportunity? Could this be a multi-billion-dollar opportunity, right? And does the founder have the ability to kind of go execute on kind of V1 of the product, right? Get some traction, get some usage, and then learn, right, and figure out V2, which neither of us know what that is, right? They have that ability to kind of, call them micro pivot earlier, micro pivoted to V2 and V3 and so on and so forth, right? And Kyle did a brilliant job at that. They're going to be launching driverless cars very soon. Another company I invested in out of Founder Collective, a company called Firebase, which was 2 technical founders. It was actually the 4th startup. The first 3 had failed. And they were building a chat engine, and as they were building the chat engine, a chat app, they realized the back-end software to enable the chat app was actually really complicated because you had to keep multiple parties in sync and so on and so forth. So what they did is they took that engine and actually productized that and said, everybody else who's trying to build real-time products, real-time web apps, let's make this engine available to them. And that's when we came in, right? They said, and what I liked about those founders were very authentic, very organic, right? They'd been building this chat app and realized the opportunity was actually somewhere else, and then ran with that. They had a really interesting vision around how hard it is to build real-time products. I'd worked at Google, had seen how hard it is to build Google Docs, for example, which is sort of this real-time functionality. And if you can enable that, for engineers to build that within minutes as opposed to weeks and months, that could be pretty powerful, right? So we invested in that company that was acquired by Google, and that was a great exit for us. Out of Afore, the portfolio is still new, 16 months old, but we invested in a company called Boxbot, for example. Founders came out of Uber and Tesla, deep technical founders, and their insight was that, parcel delivery, right, which is, taking an e-commerce package to your house, 50% of that cost is literally in the last 100 feet or so. As the UPS driver, the FedEx driver walks around the truck, drops off the package to your house, and then drives to the next house, and so on and so forth. So what if we can enable to an autonomous robot the ability to ship a package to you, right? So they've delivered this really interesting supply chain where they can shave the cost for UPS and DHL quite substantially and get that parcel to your house. What we liked here was, again, the founders are very authentic, right? They were working inside of an Uber and Tesla. They had the right skill set. They've seen the opportunity to apply kind of driverless technology, but in a very different use case, right? And as we validated the use case, as we did some research on our own, we said that makes a lot of sense. Or we invested in a company called Overtime, started by Dan Porter, who built the game Draw Something, which was acquired by Zynga eventually, which is a great outcome for him. But he has a really strong consumer kind of product instinct. And what you noticed was that millennials these days are not watching 3-hour games on ESPN, right? They're instead consuming sports content on their mobile phones, and generally very small snippets, right? So what he does through his UGC kind of app is acquire all this high school sports content. This is content that nobody owns the rights to, right? How can you acquire this sports content and then push it through the platform, right? Push it through Instagram, Facebook, whatever different channels there might be, and get a lot of, so there's millions of these video views a month because, millennials just love this content, and it's entertaining, it's short, and it's content that they can't access anywhere else. So anyway, you can see it's a whole mixed bag of different companies and different kind of sectors and applications, but the sort of the connecting thread is very strong founders in terms of product, their ability to deliver product, their ability to understand what the customers want, having kind of non-obvious insights so they can compete with the incumbents. And you know, in all of those cases, we invested very early.
And you're looking for unicorns?
I mean, look, that's sort of the venture model, obviously, is the companies who invest and eventually become, you know, big independent businesses. But, you know, we don't get too caught up on sort of what the eventual, you know, exit outcome looks like. I think part of what we tell our entrepreneurs is stay capital efficient, right? Don't raise too much money because when you raise too much money, you're forced to become a unicorn, and you're forced to, because, you know, if you're raising money at a $500 million post-money valuation, you can't sell it for 400 or even 600, right? You have to pass that $1 billion mark.
Exit options become really limited.
Exactly, right, exactly. And certain sectors, there's just not that much M&A activity for companies to buy, you know, other companies for billions of dollars, right? I think in tech, you see obviously Apple and Google, sometimes or Facebook buying multi-billion-dollar companies that are still very early, but in the rest of the world, that's actually not true. So we tell entrepreneurs, just look, stay capital efficient, don't raise too much money, stay focused on the fundamentals of the business. I mean, I'll give you an example. I invested in a company called Skip the Dishes, which is a company based out of Winnipeg, Canada, of all places. You know, it's a company basically doing food delivery. So think of like, you know, Postmates, but for mid-market cities. So when Postmates and Uber Eats and everybody's kind of competing in New York and San Francisco, and they were, you know, in Columbus and places that there's just no other food delivery service. They built a phenomenal business. They stayed capital efficient. They didn't raise too much money. They stayed focused on profitability. They stayed focused on growth, and they eventually got acquired by Just Eat, which is a public company out of the UK, for something like $200 million Canadian dollars, which was a great outcome for the founders, right, because they still owned a significant portion of the company. It was a great outcome for the investors because we did not get diluted much because they didn't raise a whole lot of money after us. We owned a significant portion.
How much total money did the company raise, and how much revenue did this get to?
Yeah, I mean, in total they raised, I want to say sub $10 million. I forget the exact figure, but it was a small number, right? Relatively small for a food delivery company. I don't know the numbers for like Postmates and stuff, but it's probably in the hundreds of millions of dollars that they've raised. Skip raised a fraction of that. And by the way, their numbers were not that far off from some of these bigger companies. So, you know, it goes to show, and a big reason for that was because they were based in Winnipeg, right, where the cost structure is just phenomenally different. They had something like 200 employees or something like that at the time that they exited. There's no way you can afford to have that many people in your company and only raise that little money in like San Francisco or New York, right? So,
but it's also a matter of culture and philosophy, right? I think part of the problem we have created in this industry is this, you know, burn lots of capital and chase hyper growth at all costs, and just make yourselves unsustainable for the off chance that you may get a big exit. This is not the way to build companies.
Yeah, I 1000% agree with you, and that's what we tell entrepreneurs. I think the challenge in the industry a little bit is that there's so much capital chasing so few good opportunities that investors push these companies to raise more than they should. And unfortunately for a lot of founders, the amount of money you've raised becomes a barometer for how successful they are, which is absolutely not true, right? You know, the number of employees you have in your company or the amount of them.
What is your read of your cohorts in the pre-seed segment of the market? Are there other players who are thinking the way you're thinking, or are they, you know, are you finding good syndication opportunities in your stage?
You mean, are there other peer investors, right?
Yes.
Yeah, there are a few.
Share your philosophy.
Yeah, there are a few funds. I mean, it's an emerging category. There aren't a lot yet. I think that may change in the next couple years. But, you know, I'd say there's probably 3 to 5 funds that are serious about pre-seed. Some of them don't exclusively do pre-seed. They also do seed and other stages. But that are seriously thinking about pre-seed and have the same philosophy that we have, which is, you know, do more with less. You know, don't raise too much capital and so on and so forth. And we do syndicate sometimes with them, though we're not sort of dependent on the syndicate. We, first of all, like to lead where we can. So we're not waiting for signal. We're not waiting for somebody else to price a round. We're very comfortable being the biggest check and pricing the round. And typically these rounds, you know, if it's a 750K round, and if we're doing 500 of that, these founders can finish off the rest with just angel investors. And in a lot of cases, we were, you know, 75% of the round, 75% or more of the round, which is totally fine. And in fact, we prefer, because we don't want the company to raise too much capital. And a lot of times they want angel investors involved in the company anyway for strategic reasons. So, you know, there hasn't been, we're not dependent on syndicates, but we certainly obviously love to co-invest where the opportunity is with some of our peer VCs. The other thing is, you know, if you think of a funnel, right, there's obviously a lot of companies at the pre-seed, right? So there's just a lot of opportunity for all our peers to invest in, and these companies are obviously not obvious, so not everybody agrees that this is a good company to invest in. So, you know, there's not a consensus a lot of times on companies anyway, which is fine. So I think that creates a lot of value for founders because now they have more optionality to raise money. So if I don't get it, you might be able to raise money from a peer, which is totally fine.
Awesome. Gaurav, this has been a very interesting conversation. We have talked to a couple of pre-seed, you know, probably 3 out of 5 pre-seed funds have already been on the show. So we will keep, you know, keep the dialogue going and hope to work with you going forward. Thank you for coming today.
Likewise, thank you. And I'm easy to find. I'm just G Jain on Twitter, but also our website is Afore.vc. If we can ever be of help, our email addresses are on the website. Please reach out and more than happy to chat.
Fantastic. Folks,
awesome.
We're going to move to the, thank you. We're going to move to the entrepreneur pitch portion of the program today. I know Gaurav has to run. Let me set a bit of expectations before we dive in. Remember, this is a working session. We are here to work on your strategy. And it's a safe place. You don't have to be afraid or nervous or uncomfortable. I will give you, you know, very direct feedback. However, my goal is to help you with constructive critique of your strategy so that you can move forward and, you know, make progress. I have no other agenda. We as a company have no other agenda than that, besides that. Now, you may disagree with my feedback. That's fine. It's your choice. It's your business. You are going to follow whatever strategy you want to follow, and that prerogative is yours. All we are doing here is giving you perspective based on our experience. Remember one thing, though, not all businesses can raise money. Not all businesses should raise money, and raising huge amounts of capital does not guarantee success. That is a fact. You cannot argue with that fact. So, Vadiraj Katti from San Jose, California, please unmute your line and tell us what Bodhi Academy is. Are you there, Vadiraj?
Hi, Pramana. How are you?
Good. How are you?
Good. Thank you so much for the opportunity. My name is Vadi, and I stay in San Jose. And what I really want to use this opportunity for is to talk to you about my idea around Bodhi Academy. I just want to set the expectation that this is still in the concept phase, and I'm still thinking through this. So would love to get more of your input. So we'll first address the boring stuff. A little bit about me. I've been a product manager for close to 5 years, and all of that experience has been in fintech. I've stayed both in Boston as well as in San Jose. Worked with companies like Fidelity Investments and Financial Engines. So most of my experience has been in wealth management and robo-advisory space. For very personal reasons, I'm getting back to India, and I want to use that opportunity of going back to India to start my own lifestyle business, something that I can have on the side while I also earn a paycheck. Are you
moving to India with a job, without a job, and you're going to find a job? What is the situation?
Yeah, I'm going to find a job when I get to India.
Okay. So, you know, this is all very consistent with our philosophy in the sense that we do support bootstrapping with a paycheck, as you know, and we are perfectly fine with that model. And, you know, somewhere along the way, if you decide that your company is scaling really well and you want to do it full time and scale it to the next level and so forth, you have that option. But starting in a bootstrapping with a paycheck mode is a very good mode to start in. By the way, you should come by to the 1M1M Rendezvous in Menlo Park next week before you go to India.
I will. Sounds good. Sounds good. So as a part of being the PM, I have heard hundreds of customers, talk about the issues that they deal with finances. Many of them, they don't make good financial decisions because they don't have the know-how, or they have made bad financial decisions, which is why they hand over the money to somebody else in order for them to manage that. And when you look at a country like India, the situation is not very different. There has been a lot of independent study which have said that only 20% of the Indians are financially literate. A lot of times, 1 in 10 households are participating in the stock market because primarily most of these households are actually investing their money in fixed deposits or bonds as opposed to really diversifying their portfolio. But if you really get to the root of the issue, it's not about they being very conservative. I mean, the fact is that we don't focus more on financial literacy when people are in schools. And the issue is even more compounded in India because you have around 200 million kids who are either going to school or going to pass out of school, and financial literacy is not really a part of the curriculum. In talking to some of my friends who are parents and teachers, the issue starts also from there because parents don't have the knowledge, they cannot really impart that to the child, or they don't have time because both of them are working, both of them are traveling. At the same time, teachers also don't have this. But India is also unique in many ways because there has been a movement in India around providing financial literacy to kids, and the Reserve Bank of India and the National Institute of Security Market. I mean, these entities are coming together, and they have created this new entity called as the National Center of Financial Education, which has been working with principals of schools in order to really push financial education to students. And they have also created a competitive national level test called as National Financial Literacy Assessment Test. And there have been other few tests that have been really coming out at a national level that kids can really take this test and win a cash prize. So my idea is more so around creating an online experience where these students and teachers can take financial literacy lessons, and they can do that in an online format. And they can access this either by coming to a website or using a mobile app. By students, they enroll into these courses in order to prepare for these national level tests. Teachers can also do that.
What age group are we talking, Vadi?
Yeah, so we are talking about kids who are in grade 6 and up.
6 and up.
Yeah, grade 6 and up. Yeah. So at the same time, teachers can also use this platform in order to really learn about financial literacy and then impart that to the kids. The customer acquisition model that I'm really focusing on here is B2B2C as being the primary source, and then the secondary source will also be B2C. B2B2C is about selling this solution to schools, because from some of the research that I've done, most of the push of financial literacy is coming from school principals, and so my model is more suggesting about selling this to schools, and then actually getting access to students after that.
Are you saying that schools are willing to pay to buy financial literacy programs?
So there has been some movement on the ground where there have been a few companies. Well, there has been one company that I know of, which is based in actually Chennai, in India, where they are really working with school. I think they have worked around 15 to 20 schools in Chennai, and they have sold this solution around financial literacy to these schools. So I'm thinking about using a similar model where I go to schools about selling the solution to them, and the intent would be where the schools are really looking to give more of a holistic development to the child, and they are looking to get financial literacy in front of them so that they can take these courses and grow up to be a lot more mature adults as compared to the behaviors that we see today.
Okay.
And at the same time, also, the banks and financial institutions can use this platform for their own programs. The secondary source is going to be B2C, where students and parents who are looking for these lessons can really find these either through SEO, Google search, or social media ads, or through any independent workshops that I intend to have, so they can learn more.
if of all the segments that you're presenting here, my estimate is the most promising segment is actually working with banks and financial institutions to have them use you for literacy programs, financial literacy programs, and not schools. Schools is going to be very slow. The level of adoption, you're going to have to first find, financial literacy is not part of the core curriculum in India, or anywhere actually, especially not at the middle school, high school level. So you're going to have to do missionary selling, and you're going to find the few and far between schools that are willing to do this. So it's not going to be an easy sell at all. It's going to be a very, very slow growth process. Whereas banks, maybe there is, you can come up with categories and segments of, bank account holders for whom the banks are willing to organize literacy programs, and they may be willing to work with you to, outsource that to you and stuff like that. I think there is a lot more promise in that category, whereas, you have to pick a good segment that you can enter the market through and that is going to be reasonably lucrative. And of all the things that you're presenting here, my sense is the banks and financial institutions are the best category.
Got it. Cool. All right. That sounds good. Yeah, that is also very similar to how I was thinking about it, because I spoke to some of the school principals, and they mentioned to me that the cycle can be very, very long, and because there are too many stakeholders.
It will be unsustainably long.
Yeah. So yeah, I was thinking about going through that route in order to charge banks and financial institutions for a platform fee, in order to really push my content through them.
And is this going to be content? It's going to be primarily a content program?
Yeah, the way I was thinking about this was content along with, games as well as quizzes all put together. So yeah, the main push here is content though. Yeah, the main strength here is content.
Okay, because, I think where it would be interesting is if you can take the content to educate your segment, and you have to pick a segment even within, if you go to banks, for example, banks have clients at different tiers and different levels. You have to pick which tier, what kind of level do you want to work with. The more interesting opportunity would be probably in the mid-tier, where people do have a little bit of assets and they're trying to figure out what to do with that tier of assets. So where you can coach them through using your content on financial literacy, but if you can also augment your offering with robo-advisors that actually help them figure out how to invest their money without taxing the bank's financial advisors. So I think that opportunity, if you kind of think about it, forget schools, forget all this SEO, B2C stuff, focus purely on the mid-tier clients of banks, and create an offering that is a combination of literacy training through content, but also has a robo-advisor kind of component to it, portfolio optimization through robo-advisor. That would be a really interesting company, I think.
Got it. Okay, that sounds great. Thank you so much for the feedback.
You're very welcome. Any other questions?
No, I think this is all I have.
Okay, great. All right, so folks, that's all we have in terms of pre-arranged programming today. We will have time for Q&A, so line up your questions. I'm going to spend a few minutes telling you about how to use 1Mby1M. And I have one ask, which is, if you like what we're doing here, please refer serious entrepreneurs into 1Mby1M. And by serious entrepreneurs, we mean entrepreneurs who understand that it takes 5-10 years to build a serious company, and that's the kind of entrepreneurs we are interested in working with. All our resources are at 1Mby1M.com. So you will find a terrific blog. If you just follow the blog, you'll learn a lot. The Entrepreneur Journeys book series, there are 12 volumes of those, and they are all case study-based books. You'll learn a lot from those as well. You can focus on a particular topic like bootstrapping with a paycheck. It's a common philosophy that we're using all over the place, and it's something that is very extensively supported in the program, and you can learn a lot about that through the case studies that we have presented in Bootstrapping with a Paycheck. Similarly, you can learn about positioning. Let's say your primary challenge is positioning. I just did a positioning exercise with Vadi, with his company, right? He had a bunch of different segments and positioning options that he presented, and I just worked with him to kind of cut through the chase and focus on something that I believe is going to be the most lucrative positioning for his company. So you will see a lot of case studies on positioning. Positioning is an area where we do a lot of work, and it's an area that is very rich in terms of returns for strategy. If you want to do good strategy, positioning is something that you need to focus on, learn, and tweak so that you can get to something laser sharp that gives you a very clear high velocity market entry into whatever category that you want to work in. There's a book on billion-dollar unicorns, so that is nitty-gritties of how entrepreneurs have put one foot before the other to build unicorn businesses. These roundtables happen every week, so keep an eye on the free public roundtables page for the schedule. Thousands, tens of thousands of people have been using these sessions, so feel free to keep coming back and learning from these. The full acceleration program is the 1M1M Premium, which is a $1,000 annual membership fee. We provide you with extensive methodology guidance, a full online curriculum, help you with business development, strategy consulting, mentoring, coaching, whatever you call it. And we also help you with financing and media relations. Go to the website and look up the 1M1M self-assessment. It's a very good questionnaire that helps you think through strategy. We'll ask you questions about your business, and you should try to answer those questions. That's how you refine your strategy. And if you get stuck on methodology issues, go to 1M1M Basic and learn the methodology. That's just a $99 a month curriculum-only option. We introduced that because people were getting stuck on methodology issues on the self-assessment and wanted something so that they could just quickly, on their own, fill that methodology gap. And here it is, 1M1M Basic. So, dig around on the website, see if this program is for you or not. It is a heavily self-study oriented program, and you will need to do a lot of studying to bridge the huge learning curve that first-time entrepreneurs have. There is a tremendous learning curve for first-time entrepreneurs, and we are trying to give you the pieces with which to mitigate that, to climb that learning curve, basically. There are video FAQs. You can learn about the program, what to expect from Premium, what to expect from Basic, what to expect from the curriculum. We teach with case studies. We have over 800 successful entrepreneurs who are part of the case study program, including 50+ unicorn entrepreneurs, 400+ venture-funded companies, 300+ bootstrapped entrepreneurs. So you are going to learn from them, learn their strategies, learn what's working, what's not working, and you basically get to stand on the shoulders of giants, and that's very effective in bridging your own knowledge gap. Our methodology is lean, capital efficient, bootstrap startups. If you raise money, you're going to bootstrap first, raise money later. As you heard today from Gaurav, even for pre-seed financing, you're going to need to get to some level of, validation. It may not be traction, but you have to get to some level of validation. And for that, you need to get 1 or 2 customers going if you're doing B2B, and lots of customers going if you're doing B2C, and that is a bootstrapped journey. That's pretty much it. We have 3 more roundtables in February. So come to any of them, book a slot to pitch if you'd like to work on your business. And then we also have these Wednesday evening rendezvous at Cafe Boroni in Menlo Park. You can come work with me in one of those sessions as well. And, those are small, intimate sessions where we have a chance to have in-depth discussions about your businesses in person. That's pretty much it. Otherwise, we have open Q&A now, so feel free to either dial in and ask your questions or use the public chat to introduce yourselves, tell us what you're working on, ask questions, whatever issues you want to discuss at this point. The line is open, the chat room is open. Let me also introduce you to Irina Patterson. If you have questions about the program, you can contact her, Irina at 1Mby1M.com. She'll be very happy to answer any of your questions. So, anybody? Questions, comments, issues, introductions? What brings you here? Maureen, could you also put the SAS article that I wrote on Monday in the public chat? I want to take people through a little bit of the perspective that I presented there, because it's important perspective and I'd like people to know about it. So there's an article that I wrote on Monday that was in our newsletter. If you follow our newsletter, you may have seen it, or the blog. It was on the blog and on my LinkedIn column as well. It's called SaaS Companies, You Have an Unprecedented Opportunity. What I'm pointing out there is that there have been a tremendous number of seed investments, and that by seed I mean pre-seed, seed, post-seed, pre-Series A. Of late, I think we are seeing 100,000 a year of these kind of investments, whereas the venture investments, Series A and beyond, is 1,200 to 1,500. So there's a lot of companies that are falling through the Series A gap. As last week we had an investor, Rajiv Madhavan. He pointed out that the Series A gap actually is widening. So you really have to factor a lot of things in your planning, in your strategic planning of how you're going to navigate all this and make sure that you don't get caught in a Series A gap. And there will be a lot of interest from larger companies, especially in SaaS, because there are a lot of SaaS companies that have reached critical mass. There are lots of companies in the $100 to $200 million range. There are even more companies in the $50 to $100 million range that are looking to grow fast, and they're looking for acquisitions in their adjacencies. So if you want to tap into that opportunity, read this article and feel free to come talk to me. It's something that we want all entrepreneurs out there, especially the pre-Series A, that's whether it's pre-seed, seed, post-seed, pre-Series A, all of you who are in that segment to know about what's going on, what are the dynamics of the market, and how should you play your cards in this segment. So I'll be happy to answer questions in this session or the next session, but do take the content of this article into account. All right, folks, questions, comments? Yes, no? If not, we're going to wrap up, and we'll be back here next week. We'll be actually back on Wednesday at the in-person session and Thursday at the roundtable, online roundtable. So come to either, both, whatever you prefer. Okay, well, goodbye then for today, and we'll see you soon. You're very welcome. I'm glad you enjoyed it, Josh. Bye-bye, everybody. Hope you make a lot of progress during the week, and we meet again next week. Bye-bye.